Best agricultural financing options for recent graduates starting a farm. Good evening, everyone. My name is Ethan Calvis, and I'm a junior here at Texas A&M Kingsville, majoring in agricultural business, originally from Alice, Texas, and graduated from Agua Dulce ISD. Today, I'm excited to present my research on agricultural financing options for recent graduates starting farms. This topic isn't just academically interesting to me. It's deeply personal. My future aspirations is to manage a large ranch or own my own operation, and how understanding how to secure financing will be critical to achieving that goal. I chose this research topic because it directly relates to my career path. Whether whether I'm managing someone else's ranch or starting my own, I'll need to understand capital acquisitions in the agricultural industry. Access to financing often determines whether talented, educated graduates can actually enter the field or remain stuck on the sidelines. This isn't just about me, though. The agriculture industry faces a workforce sustainability challenge. The average age of farmers in America continues to rise, and we need young people entering agriculture. But without access to capital, even the most qualified graduates struggle to start operations. Here's my conceptual module. Problem identification. Recent graduates face barriers to agricultural financing. Then we have research questions. What options exist? Which is best for different profiles? Then we have data collection, online sources, interviews, and surveys. Then we go on to analysis. Compare 5 financing options across the criteria. Then we go to recommendations. Match solutions to graduate profiles. Some information that I gathered. To conduct this research, I used 3 primary methods. First, I extensively reviewed online sources, including USD resources, FSA documentation, agricultural banking websites, and financial planning guidelines. Second, I conducted interviews with agricultural loan officers and extension specialists who work directly with beginning farmers. Third, I distributed questionnaires and surveys to recent agriculture graduates to understand their financing experience and needs. This multi-method approach gave me both the institutional perspective from lenders and the practical, lived experience from farmers who've recently navigated this process. Let me paint a picture of the challenge. Starting a farm requires massive upfront capital, land, equipment, livestock, and operating expenses. Often before generating any income, unlike other industries where you might bootstrap a startup, agriculture demands significant investment from day one. Recent graduates face particular barriers. Most lack extensive credit histories, have limited collateral, and can't show production track records. Traditional lenders view them as high risk, even when they have excellent education and strong business plans. This creates a catch-22. You need experience to get loans, but you need loans to gain experience. Let me walk you through each operation or each option. Option 1, FSA Direct. Operating loans are specifically designed for beginning farmers who can't obtain commercial credit. They offer interest rates for just 3.5 to 5%, well below market rates. You can borrow up to $400,000 with repayment terms extending 7 years. The approval process takes 60 to 90 days. What makes these loans special is their accessibility. The FSA takes a holistic approach considering education, businesses, plans, and potential, not just credit sources. This is best for graduates who limited capital and credit history. Option 2. Commercial bank agricultural loans represent the traditional financing route. Interest rates run to 6 to 9%, and you can access anywhere from 50,000 to over $1 million. However, banks require strong credit, typically scores above 680, solid collateral, and comprehensive business plans. For well-qualified borrowers, commercial banks offer quick approval, often within 30 to 45 days. This is best for graduates with established credit and family assets. Option 3. Agriculture credit unions occupy a middle ground as member-owned cooperatives. They offer rates between 5 and 7.5% with more flexible eligibility than commercial banks. Loan amounts reach $500,000 or more. What distinguishes credit unions is their community focus and personalized service. They are often more willing to work with borrowers who have moderate credit but strong character and community ties. This is best for graduates with rural community ties and moderate credit. And then we have option 4, private investor partnerships. Take a completely different approach. Instead of borrowing money, you bring in partners who provide capital in exchange for equity or profit shares. Investors typically expect 15 to 25% annual returns. This optional works well for innovative ventures, organic farming, specialized crops, or direct-to-consumer modules. Not qualify for traditional financing. The trade-off is sharing ownership and control. This option is best for innovative specialty crop or sustainability agricultural ventures. Then we have option 5. USDA guaranteed loans combine commercial lending with government support. The USDA guarantees up to 95% of the loan, encouraging lenders to approve borrowers they otherwise might decline. Interest rates run 5.5 to 8%, and you can access up to $1.8 million. This makes guaranteed loans excellent for graduates who need sustainable capital but fall slightly short of commercial bank standards. This is for graduates, yes. Here's a side-by-side comparison. You can directly see each loan option rate, max amount borrowed, and timelines. Some of my key findings. My research revealed several important insights. First, FSA loans offer the best terms but require the most patience. That 60 to 90-day timeline demands advanced planning. Second, commercial banks prioritize credit worthiness over agricultural potential, which can exclude qualified graduates. Third, credit unions provide an often overlooked middle path combining reasonable terms with accessibility. I also found that private investment increasingly appeals to graduates pursuing sustainable or innovative agriculture, and that USDA guarantees effectively expand access to larger capital amounts for beginning farmers who need them. After analyzing all 5 options, my primary recommendation for most recent graduates in FSA direct operating loans, here's why. The interest rate advantage is sustainable at a 4% versus a commercial bank's 8%. A graduate borrowing $150,000 saves approximately $6,000 annually. That's $20,000 to $30,000 over a 5-year term. That savings can mean the difference between success and failure during vulnerable startup years. FSA loans are also specifically designed for beginning farmers for eligibility criteria that recognize education and potential rather than just requiring established assets and credits. The flexible collateral requirements and the comprehensive support throughout the application provides critical assistance to new farmers. However, I want to emphasize that this is a profile-based recommendation. A graduate with the family land and established credit might do better with a commercial bank. Someone pursuing organic specialty crops might benefit from private investment. The key, matching financing to individual circumstances. Alternative recommendations include limited capital crop farmer, choose FSA direct operating loan. Livestock producer with family land, choose commercial bank or a credit union. Specialty or organic, choose private investor partnerships. And for a large scale operation, choose USDA loans. Action steps for success. Regardless of which option you pursue, I recommend 5 action steps. First, develop a comprehensive business plan with 3-year financial projections. Quality plans significantly improve odds across all financing types. Second, establish relations with multiple lenders before you need capital. Third, maintain accurate financial records from day one to demonstrate management capability. And then fourth, consider blended financial approaches combining FSA operating loans with credit union equipment financing. For an example, fifth, seek mentorship from established farmers who navigated these processes successfully. Some personal applications. This research has direct application to my future career. Understanding which loans support different operational scales will inform my management decisions. Knowing how to access expansion capital will enable growth. Selecting appropriate financing structures will help risk, and this knowledge positions me to advise others on financing decisions and increasingly value skill in agricultural management. Some lessons learned. My biggest takeaway is agricultural financing, while challenging, offers multiple pathways for dedicated graduates. No single best options exist. Context matters, but with understanding and planning and strategic thinking, financing is accessible. In conclusion, the agriculture industry needs young farmers, and these programs exist to support us. Final thoughts. Agricultural financing, while challenging, offers multiple pathways for dedicated graduates. Success requires understanding available options, honest self-assessment, strategic planning, professional relationship building. The agriculture needs young farmers. I want to thank Dr. Price and all of you for your time and attention today. If you have any questions or would like to discuss this research further, I'm happy to continue this conversation. You can reach me at my email listed or my number. Thank you. And here are my references.